But the thing to be wary of with selling climaxes is you're almost always, and I mean almost always, going to come up, but the thing isn't just going to keep going to the moon. So we got to come back down and see, are there more sellers down here? If I can drive that price down, can I find sellers? And as they drove that price down, there's really nobody that's selling, right? How do we know that? We're comparing the action on that volume bar in this range, right, over here. We drive this price down. Well, where are the sellers? Really not too many people interested in selling, obviously, because we can check all the activity on the chart by the volume, and there's not a lot of volume there. It's less than half. It's probably a third or thereabouts of the size of that volume bar on that selling climax. That's how they're testing for this latent supply. Are there more sellers out there? If there are, as that price is marked down, and that is a mark down, it's not just doing that by accident, they're marking that down, who's down there? I want to find out if there's more sellers. If there's more sellers, I cannot, as a professional trading interest, allow this price to go up, because what's going to happen? Somebody's going to just come down with big supply and sell hard because they can, because they know there's supply there, and they actually could own it. They could say, well, all right, I'm getting out now. But this is where the dog eat dog comes from, but that's how they test for it. And I'm going to show you there's another term for it that we're going to call a test. But here's another selling climax. See, this is the way they're going to look, though. You're going to have that one big rampant down bar. It's not going to be sustained. And when you see it, it's going to be that big volume. That's what it looks like. And this is a daily bar for, guess what that is? That's American Airlines. When we talked about the airline stocks, Continental Airlines, American Airlines, that's a recent chart. That's daily from 5/21. That just happened. Look at Continental Airlines. Continental Airlines went from $50 down to about $15. And you look at this, and you start saying, hey, there's sector rotation going on. This proves it, right? I can't tell you today because we've got to test through this possibly. We don't know it's just going to keep going up. It might come back down and test for supply again. That's why you can't just automatically go in and buy, my opinion, selling climaxes. Some people might find that's a profitable way to trade, though. It might fit with your personality. But you would expect something like that to rise, right? Because the only way that can happen is if there's professional interests and retail traders on the opposite sides of each other. That's the only way that can show up on a chart. Before I move off selling climax, are there any questions? Well, we have charts here for selling climaxes. Mike?
What time frames are you talking about? You've shown daily, weekly.
Gentleman asks, what time frames are we talking about? Obviously, when you see this on a longer time frame chart, it's going to have much more meaning as far as the future price direction, the maximum of that price direction, I guess, if you want to say it that way. That on a weekly chart means a lot. If that were a 5-minute chart, everything we're talking about, it's like chaos theory. I know chaos theory is one of those physics terms, and people go, oh my God, don't start talking about physics. But chaos theory tells us that the same things happen on different levels. Right? So it's just a little microcosm of itself. That on a 5-minute chart, the same thing can look just like that, and it can move up. But when you go to a longer time frame, it's going to have more significance that this is actually real accumulation happening from professional interest in a big way versus if it's a 5-minute chart. But what you would want to do here, I think it's a good question, what you'd want to do here on this daily is we could look at a weekly. How does this look on a weekly? Then we could look at, say, where's the 60-minute? What is that 60? We can break that day down into 60-minute chunks. On that 60-minute chunk, where did all that volume come in? Did all that volume start at the top and drive it down, which would make it suspect for a selling climax, or did all that volume come, as I would suspect it did looking at that chart, did all that volume come in on the bottom as we're bottoming out, and then that's where the professionals were taking their positions? For the person that said, hey, I look at market profile is very good at doing that. That's how I use market profiles. You can break that down now. Market profile, for those of you that don't know what it is, market profile just takes a day and puts it on a distribution basis. You can do it any time frame you want, but the most common way is 30-minute increments. And there's a letter for every 30 minutes, A, B, C, D. And it's Peter Stottlemyre who did this, as I understand it anyway, back in the 1980s. CBOT got involved in it and started keeping track of it. But basically all you're doing is taking the volume and the price activity and trying to define where those levels are. So on a market profile chart, you can go home now and you can put that on market profile, American Airlines, and on the 21st of May, and you can see exactly where that came up on market profile. You can do the same kind of thing if you break it down into just smaller chunk bars, but market profile makes you able to see it. There's more there that you can see all together.
So you're saying it's fractal, but the logic is the same?
Correct.
Logic.
You said it better than I did. Yeah, the comment was it's fractal. The nature of it is fractal in nature, but the concept remains the same across all time frames. But we use time frames to actually confirm what's going on. And again, just to be redundant, I want to go down there, I'm going to go to a 30-minute chart and a 60-minute chart, and I'm going to see where that volume came in. And I am going to go to a market profile chart and do that. That is what I'm going to do. But you can do the same thing if you don't understand market profile. You can go and do this just on bar charts or candle charts.
The second highest bar is the last bar. So can you address that?
Yep, that's supply. That doesn't look good. That doesn't bode well for higher prices right now. And we expect it to come back down and test. And especially with airlines right now, I don't think you're going to see, okay, bam, we got everybody out, now it's just going to go up. I mean, we still got to shake people out. The news is still in the paper, right? The media is getting involved now saying, these airline stocks, people are laying people off, these fuel costs are too much. Just the news is so bad that that's the story being created and reported to us as consumers and individuals and traders, that now we've got to go through. We went through the process to start with, that a lot of us as retail traders we're out. We're out of American Airlines, we're out of Continental Airlines. You can go and do some sector work, so go and look at all the airlines, right? Look at all the different airlines, go home. That's a good project to do tonight or tomorrow, is go look at the airline stocks and see what you're seeing yourself. But you're going to see a lot of that. You're going to see a lot of it. But this thing on the right edge of the chart, yeah, that's an up bar, close, kind of lower than the middle, which says we tried to push up here, and as we're pushing up, we're getting supply pushed back down on us. There's still sellers there. And what we need to do before we can get out of the accumulation phase and get into the markup phase is we have to get rid of all the supply that's there. And the only way we do that is by doing what I'm going to talk about next, testing. See, tests appear in a price bar that's going to trade underneath the previous bar's low. So we're taking out the low of the previous bar, and we would prefer for that to close in the middle or the high of the bar. Those we're going to call tests. If those close in the middle or the high of the bar, we know we came down. Try to see if there were sellers there. There weren't, and we came back up. And at least we closed off the low. We closed in the middle of the bar or the high of the bar. That kind of tells us, well, if there's very little volume, so there can be greatly reduced volume reflecting the lack of sellers at that price level, showing professional that there's no more supply. There's no more supply that's going to be hit on them as they allow the thing to get marked up now. They could start the process, just kind of push it along to get it rolling, and then they can back away and just let, the mutual funds, pension funds, banks get involved. They start buying it, and then after those people are done buying it, then the retail trader starts to look at it, the media starts to report on it, and then that whole process goes through the markup phase when we get back to distribution. Right? That's why the retail trader is always the last one involved, always, and always will be. But also with a test, there can be relatively high volume, reflecting that either demand at that level we got down low enough where the professionals say, okay, I'm just going to come in and buy more now. So reflecting demand overcoming supply at that price level, or that there are still active sellers present. If you've got a high volume test, you are going to need to expect a retest in the same general price level. And I'll show you what I mean on a chart. If you've got a low volume test, that's something you like to see a low volume test because you know there's no more supply after you have the selling climax, right? You had to have the selling climax to start with. If you just see a low volume test anywhere in a chart, you lose a lot of the significance of what that's telling you. What you need to know is that you had this selling climax in the background. Now they're coming down the same general area and they're going to test for supply. Are they finding supply? No. How do we know no? Because we've got low volume. And we're coming back to close off the lows. We could have low volume closing on the lows with a really decreased range of that bar, and we would call that a no supply bar. But I'm just trying to keep it simple right now. But You could almost call that a no supply bar there because it's not really closing off into the middle, right? But we lost the velocity. The velocity on that bar just got jammed. It's really small. So, I'm sorry, the one with the vertical cursor, right there. Yeah, each of my charts is going to have, just look for that vertical cursor on the chart. But now you see the volume's gone. And in this case, we really didn't have a selling climax. We've still got an uptrending market. This is getting into more esoteric stuff, but this is another great thing. If you don't have a lot of selling in the background and you see one of these, this is a great place to add to a position if you already got one. It's a great place to get into a position. If you like the stock and it maybe got away from you, or if you like the future that it got away from you, or if you're trying to find, maybe you're coming close to options expiration and you want to do a real quick play on an option and not spend a lot of time decay money, and you see something like that happen, the great thing about a test is a test has to have a reaction right away for it to be successful. We can have a test. I'm going to show you what a failed test looks like. I'm going to talk about what a failed test means to us as a trader. But we can have a test, and if price doesn't react to that test, that's very bearish, right? That's not good. What we want to do is see that market react right to it and jump right back up. Question?
Could you be a little more specific on how quick it needs to react? Because I've heard, some people that are good with price and volume say it could mean 3-4 bars. So what would you define as right away?
Right away. The next bar has to have a low that's higher than the 10 bar. Okay? So this, if that bar came down here, I don't like that. You don't want that to happen. You want the next bar low to be higher than the test low. And really, you'd like to see a nice spread up, nothing like this, but that's nice and comfortable. That's sustainable. If you get that big wide spread, then now you got potential selling coming in. Go ahead. No, go ahead. We'll finish up with your question.
Actually, just kind of follow up on what you were saying earlier, for those that have studied more, I guess, of a pure Wyckoff method, what you're talking about there in the test would also be known, correct, shortening of thrust. That would be one.
Mm-hmm.
And then since you're talking about candles, wouldn't that appear as like a doji or a hammer candle, possibly?
I'd call it more of a spinning top. Let's see what it...
Okay. Thanks.
Yeah. You've got a 16-cent difference between the open and the close, and it's a narrow range, so I would say it would probably be a spinning top to me. But a spinning top, no supply, spinning top test, it's a strong signal. Yes, ma'am.
Okay, on May 20th, you did a test of the high at 131. You closed below the middle part of the bar, creating either a shooting star.
Let me put my arrow where you're talking. Tell me where I'm close.
No, at the top at 131. That bar.
Okay.
Okay, so that was a test. That was a double top.
Well, no, that's not a test.
Oh, that
Not in
wasn't-
Wyckoff terms.
Why not? Because that seemed to have gone to as high as the previous high. Did an M pattern at a top.
First paragraph, tests appear on a price bar trading under the previous bar's low. See that?
Okay.
That can't be a test. You're talking terminology that you're testing the top. You got a double top there. You're testing to see what's going to happen there. But in Wyckoff terms, well, in a real Wyckoff course, he would say you are testing that top. But to make it simple for people, because I don't want to call a test one thing and then call it a different thing, right? A test, in my terminology that I'm going to use with Wyckoff, a test has to be a price bar trading under the previous bar's low. And on that occurring, you're going to have the close of that price bar in the middle or the high of the bar, and preferably on low volume. You can be on high volume. If it's high volume, you're probably going to retest though. You probably got more supply down there. That's not 100%, but it's a good thing to look at and start recognizing the patterns as you take this stuff home with you. Okay, here's another test. Now that's a real test. That's a good test to talk about what we were just, in the context I was talking about. And I shouldn't say that's a real test. Let me rephrase that. That is a test that's happening after what?
A high volume low.
Selling climax. We got this test happening after the selling climax. Now look, we got this. We look at this. If we box this off, there's the high of that range, there's the low of that range, and that test is happening in the range of that bar. Ideally, that's what we want. We're not going to get them all the time. Sometimes we're going to go down lower. So we'll take out the low and maybe go below this. But if we still had something looking like that after we had this, that's good. And to answer the question in another way of the gentleman that said, well, how quick do you want it to react? That's a reaction. That's what I like. You need that thing to react. You might have, what could happen is you could have a couple dojis going across kind of sideways, but the low of those next bars do not take out the low of that test. Once you take out the low of that test, pretty quick after that, we've still got a weak market. We've still got to retest. We've still got to find out if there's more supply. And I should say we have a potential weak market. The supply might be gone, and it just didn't take off right away. But majority of the time, you're going to see it kind of meander and go down again and retest, as it compared to going up like that. But that's a textbook case of what you want to see in a chart.
If it was textbook, would you want to have low volume? To me, that looks more like average volume.
It's a good question. The question was, wouldn't you want to have low volume versus something that she's saying looks like average volume? But and it's good because I want to make sure I cover this. What we're also going to measure it against is we want to measure it against that volume. Right? We have all this coming in. So right in here, we're going to take that and say, okay, that's about half of that. That's good, but it's a good point because it still might not, it might be too much. This is where the art of Wyckoff comes in. Right? I can't tell you that, yes, you need to have that little amount of volume and then it will take off because it happens different. This is where our experience as chart readers is going to start to take effect. What you'll do here, I'm glad you said that because it brings up a lot of good stuff. What you're going to do now is go look back on the tests that Intel itself, or the S&P, if the S&P is on that chart, or the Dow, or the Euro dollar versus the dollar. You're going to look at that particular instrument and say, well, what kind of test is that needed to cause reactions? Do the tests normally happen on something that looks like a little higher volume than normal, or do they really need really low volume to take off? That's where kind of that personality of the market can take effect. Okay, and then the shakeout. This is the last part of the accumulation phase. The shakeout is going to happen. They've done the selling climax. That's over with. They've tested. Doesn't appear to be any more supply left. However, sometimes they want to make sure that there's no supply left, and sometimes they want to put the little extra kicker in to make you the impetus to make this thing go up. I'm going to show you how they do it. So this is going to occur on either one or two price bars. There's usually, right, not always, going to be an increasing acceleration of the price and volume, and it's usually going to result from bad news. So the media is unwittingly saying, this doesn't look so good. The last people out there that are, weak holders that they're trying to get rid of are going to say, well, I've sustained enough of this. I mean, I thought it was going up, but obviously it's not. I'm getting out. And so the news is going to play an effect. It's designed to lock in weak shorts right away. And it's designed to also shake out early long. So if you establish a position, you saw this test, so you're Wyckoff analysts now, Wyckoff traders, you saw the test and you say, okay, I'm in. Well, depending on your conviction level, you still might not be confident in your abilities, and you could be easily shaken out of your decision. So they're going to make sure. And this also designed to lock out new longs at this price. The last thing they want to do is take us along on their ride, free. They can't make money if they allow that to happen over and over. So here's how they do it. There's a shakeout, right? And again, it's not textbook in the case we're talking about because we don't see the selling climax in the background and the testing in the background to go through it, but that's what a shakeout looks like, right? Right where this vertical cursor is again. Right there. The reason that's not a shakeout is, or not a no demand, I'm sorry, getting ahead of myself, not a test, is really that the velocity is too much, right? Remember, let's see what we said back here. Usually an increase in acceleration of price and volume. And we can see that there. There's an increase in the acceleration of the price and volume. And I think I'll have a better example to show you maybe the ideal textbook selling climax, testing, shakeout. But that's a shakeout nonetheless. There's a shakeout that was going through distribution phase just coming out of it. This is a 2-bar shakeout though. See how this happens? They'll jam the price down to try to get people to go short, to try to eliminate people from taking a long, to try to get those early longs out. Then they'll jam it back up. And this is an unusual bar, that's why I wanted to put it on here, but they'll jam it back up, and you know, as fast as it went down, it comes back up. And now you're locked into your short position. You took a short, you're locked in. It's not going to really come back down for you for the most part, most of the time. So you're holding a loser right from the get-go. That's important for the professional because how do you get out of your short? You got to buy. That's what they want. You buy, it pushes that price up. Right? We're unwittingly being used by these people for their profit. And they've done it forever, so this is what they do. But the thing that I found interesting on this one that I want to put as an example, it's almost like another shakeout. Right? There's another shakeout right after that. And there you've got the increase in the volume that you didn't have with the first one. And so you got a 2-bar followed by a 1-bar. That's why I said 2-bar plus. 2-bar followed by 1. You're not going to see this most of the time, but these are the little nuances that you're going to find as you start to pick this stuff up. Now that you can go home and say, okay, well, I understand this. You're going to watch this video a few more times, I'm sure, before you get comfortable with this stuff. But you say, well, how did that happen? Well, they wanted to shake out one more time, and you can see the reaction from that. It went back up. And this is a 15-minute bar on the E-mini S&P. On the 15-minute bar, you were around 13, looks like, let's call it 88. And then from that shakeout, we went up to 1406. So 1407, actually, it looks like. So that was a question on the fractal nature, right? Yeah, this is 15 minutes. But we still moved up a huge degree on a 15-minute chart in an E-mini S&P contract. That's a great move. This is an old chart. This is the London tube bombings back on 7/7/2005. You talk about the mother of all shakeouts, and that's it. This is a different chart. This is an E-signal. This is my old super charts program, but you can see that volume. See, there's no mistaking that volume. You can see the increase in the velocity of the price and the volume. And where does that price close? Again, just to make sure that everybody sees this, I'm talking about this bar right here. We come back to close on the very high. On the very high. That was a huge shakeout. And you look at the move that comes from it, that went down to, let's call it 1280. We went up to about 1360 in a matter of days. That's a daily chart. Yes?
Yeah, on that one, with my experience, limited experience compared to you with pricing volume, I don't really see any legitimate testing there. That looks just like what you'd see in the Forex, like V reversal, bam, it's gone.
News.
Agree?
Yes, news. News caused that, and it wasn't news that was predictable, so to speak. I mean, yes, the people that did that knew that was going to happen, and you saw the same thing with the World Trade Center. You could, if you looked at the charts in the Globex session of the World Trade Center when we got the planes rammed into us, that same thing happened. But you could see people taking shorts, actually, in the Globex session overnight before 9/11. But this, yeah, I mean, that's a news event. That's totally, or news event isn't even the right word. That's a catastrophe. So that's going to play differently. Yep. Somebody else have a different question? Thought I saw a hand. No? Okay, so that is the accumulation process. We went through the big three. Climax. That has to come first. Then we're going to have testings and shakeouts happening inside there, right, after that selling climax. That doesn't mean to say that you can't have shakeouts and tests as we go up. Tests in a rising market are a great thing. They're an awesome way to put your position on because you know by looking at the chart behind you, you got all this accumulation that happened, professional money's behind you, the wind's behind your back, and you take advantage of every test that you can as it moves forward. Every test that happens, and remember a test has to be, this bar is lower than the previous bar's low, right? And it's going to come back to close in the middle of the high of the bar. And preferably with those tests in a rising market, we want really low volume. Because if it were higher volume, then it's kind of a nebulous situation. We don't really know what that's telling us. That could be the start of supply coming in. If we have low volume, and I mean low volume that you seriously see it's low volume, then you've got a great opportunity. Now, market weakness, we talked earlier and said market weakness is not what you think it is on a chart. Market weakness appears on up bars. And I should say an up bar or up bars. The reason for that, put yourself back in the place of the professional, right? They need to get rid of what they accumulated down here. It's time for the inventory process to clear out. They want to clear out the longs and get rid of those and then establish their shorts. The only way they can do that is to sell to somebody. Who did they sell to? Retail trader again, right? We're always on the last end of the stick. We always get the short draw when we're pulling the straws, and we always will. The only way we won't is if we know this is going on, and this is what Wyckoff was all about, saying you need to understand this process. If you can understand this process, you can stop it happening from you. And that's the most important thing we're all worried about is us, right? I mean, it's great to be nice to everybody, charitable, but in the end, we have to worry about our own pocketbook. And we can't let this happen to us. So they want to unload their profitable longs and enter short positions without driving the price down against themselves. If they just start selling, they're going to just push the price down, and it's going to take the profit equation away. So they have to get out while the public's buying. And that's what we call here the hypodermic technique. They're going to stick the hypodermic, the adrenaline in the market, and it's going to just go up real quick, and then it's going to die. And that starts the distribution process. And it's also called the whooping up session. These are terms from Wyckoff's course back in 1931. He used whooping up and hypodermic technique. Those were his terms. I think hypodermic technique is probably not politically correct anymore. But we can still call it whooping up. But buying climax, it's the opposite of a selling climax. Right? If you just think of it that way, that the rules that applied to a selling climax, we had to see the increase in the velocity, the price, and the volume massively. You need to see that same thing, except instead of down bar, you're going to be going on an up bar because weakness shows itself on up bars. So extremely high volume denoting the transfer of ownership from strong holders to weak holders. Price velocity increases dramatically as seen by price action. Generally occurs on very good news. This is what makes it hard, right? The public is out here hearing all of this good stuff, and you're sitting here saying, but Todd, you're telling me that this is bad. Yes, I am. But if you don't know this stuff, you don't know it's bad. That's why it's hard to start saying, I want to get out. There's a question over here.
Yeah, do you have a rule of thumb when you talk about high volume where maybe, if it's twice the average volume or 3 times the average volume or greater than that at the top or greater than that at the bottom, that you have certain rules of thumb that you really look for?
Can I pick on you for a second?
Yeah.
I don't want to offend you.
Go ahead.
Are you an engineer, scientist, doctor? Yeah. Okay. See that, and I don't mean that in a bad way. This is what we want when we're in those professions. We want some scientific way to do it. My easy way is be the artist, right? Be the artist and say, I'm going to see it. It doesn't. If you wanted to you could play around with that. If you like to code things up, you could say, I want 2.5 times average volume. You could put a moving average on the volume and say, I want 2.5 times the average volume. That's something you could play with. But do I do that? No, I don't. You're going to see it. It's going to be very evident. There's no mistake. Because not only are you looking at volume, you need to see the increase in the velocity of that price action. So that price action is going to take off on that bar. Right? You're not going to see just a normal little bar like you have before. You're going to see the big volume, and you're going to see the big price jump.
Wide range bar.
Yeah, wide range bar.
I think the reason I ask that, you see guys like Adami on CNBC, who I think of as a pretty good trader.
I like him, yeah.
And he will mention, you're going to see a big volume day, or we've already seen a big volume day in this stock. And he'll mention the exact number of shares he's looking for. So I'm thinking, what's he looking at? Is he looking at twice the average volume, or how does he pick that 140 million share day?
Yeah, and I obviously don't have the answer to that because I don't know the man individually or personally, but it's a good thing because I got to end this film in about a minute. It's a good thing to play with, and this is always good. I always tell people to do this. I'm not a programmer. I don't know how to do any of this stuff, right? You put me in front of a computer code and I can't do anything. I'd love to be able to know how to do it because then I'd play around with all kinds of stuff, but I don't do that. But if somebody has the wherewithal to code stuff, those are great ideas to play with. Say, look, I want to see if maybe there is a magic number. Maybe I need 2.5 times or 3 times or 4 times to really know. Maybe you got merit there, and I just don't do it that way. It doesn't mean that I'm right and you're wrong. It's a place for you to go down that avenue, because one thing I can assure all of you of is we're not born experts at anything we do, right? It's a learned thing. I've done this for a lot of years, 23 years of trading, and it just takes all these different ways, like you're thinking, hey, maybe it takes a little more scientific thing with that volume, that maybe there is something there. I can't tell you there's not. I can tell you, though, just to finish this tape, that you're going to see it very clearly on your chart. That volume and the velocity increase of that price, the wide range bar, it's going to be very evident.